We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Pento from Pento Portfolio Strategies. Thanks for joining me today, Michael. How are you?
Good to be with you, Tom. Doing good.
So reading through your latest commentary, you go through the debt numbers leading up to the '08 Great Financial Crisis. And it's amazing to look at the numbers side by side of, let's say, just total debt, for example, growing leading up to '08 by $7.3 trillion versus $14.4 trillion over the last 2 years here. So just looking at this one metric alone is somewhat mind-boggling, but it makes me wonder. We know that there were changes made to lending standards and practices after the mortgage-backed securities collapsed back then. But doesn't this just mean that there is now a greater debt bubble in search of a different looking pin to you?
Yeah, it's a great question, Tom. I mean, but I guess it's a self-serving answer. It's obvious to me. I mean, we now have $68 trillion in total financial debt, $68.9 trillion in total non-financial debt outstanding, as opposed to $33.5 trillion that was extant prior to the great bubble implosion. So I look at it this way. You took interest rates to 1% and left them there for about, say 2 years in 2001 to 2003, 2003, 2004 timeframe. And that engendered a housing bubble. And then you had all this debt also piled on to it also. And then following that, for 10 of 14 years, 10 out of the last 14 years, we took interest rates to 0%. Mm-hmm. Not 0%. And then we raised rates from 0 to 5% in 1 year, on top of almost $69 trillion in total non-financial debt. So to me, it's obvious that it's a prima facie evidence that the amount of debt, destabilizing debt outstanding, has increased incredibly since 2008 in nominal terms. In terms of GDP, it's much worse, even, as a percentage of the underlying economy. And the rate of change in the hawkish monetary policy is even worse than it was in '08. So is it a guarantee that I'm correct? No, but it's a guarantee that the asset bubbles exist, created by massive leverage in the financial system and in the economy, and distortion of interest rates brought about the same bubbles in real estate, but also added in the bubbles in equities and in the bond market as well. Mm-hmm. So think about this, just to wrap up this one answer. The Fed's balance sheet went from $800 billion in 2007, at the end of 2007, to $9 trillion in 2022. So if you think that base money supply increase didn't engender any misallocations of capital, you would be wrong.
But Michael, we're doing QT and doing a great job at it. That's going to help bring the balance sheet down, isn't it?
See, another great. I understand your question. So we were doing QT. The balance sheet went from 9 trillion to 8.3 trillion. But then, I know the banks are well capitalized and there's nothing wrong with the financial system. And we'll never have another financial crisis in our lifetime, according to Janet Yellen. Mm-hmm. But then a funny thing happened. We raised interest rates and we blew up 3 banks. Okay. And then we came up with this, I call it QE Lite. It's not exactly the same as QE, this bank term funding program. Mm-hmm. They're loans to banks that are insolvent. They have to be paid back within a year with interest, but it's still sort of QE because the Fed printed $400 billion in 2 weeks and handed it to the banking system. So does it make a difference? Yes, it absolutely makes a difference. Does it help in the short term? Absolutely. Is it absolutely QE? No, it is not. QE is when you tell the primary dealers, here's hundreds of billions of dollars, if not trillions of dollars, whether you need it or not, go out and buy more bonds, go out and make more loans with this base money supply, these reserves, because there's more QE coming behind it. That's QE. BTFP, Bank Term Funding Program, is, hey, you're a bank. If you're in trouble, we will take your assets, give them to us, the troubled assets. We'll give you the par value of these assets. We'll hold on to them for a year, but you have to pay us interest, a 4.7% interest. And these assets have to come back to you within 12 months. So it's not the same, but it is a palliative Band-Aid on the whole hoop show known as the U.S. financial system.
Mm-hmm. Yeah, it's funny. You know, I actually pulled a quote from your last newsletter, and she said that she believes that the banking system has solid capital and liquidity, as you were just saying. So does she mean that now after those three banks failed?
Yes.
Right.
Oh, yes, absolutely. She said it after. She said it in front of a speech from the World Bank and IMF meeting. So he absolutely means that. Mm-hmm. Of course, this is the same person who said that the housing, bubble wasn't a problem and it's not going to affect the overall economy in 2006 and 7 and 8, and there'd be no recession. So yes, but the sad truth is we have a fractional reserve system, like it or not. That's what we have. Yep. Debt-based monetary system. And if there was ever a run on the bank, in other words, if everybody or a good proportion of the depositors want their money back, every bank on the planet would be bankrupt, insolvent, and then bankrupt. Mm-hmm. It's just math. There's just not enough money in there based on the loans and deposits that they have.
Right. Michael, you've spoken before about the inflationary cycles and different aspects of them. Where are we in this cycle right now? And do we just keep repeating the same mistakes from the past, ultimately making the final problem, let's say, worse?
Yeah, that's exactly what we've done, starting in 1987 all the way to 2023. All we're doing is we build up an asset bubble, and then it bursts. We lower interest rates, and then we build up another asset bubble, which is even greater. We distort markets. We've abrogated and usurped markets. So thinking in the collapse of the NASDAQ bubble, we took interest rates to 1%. Then we raised them back to 6%, 5.25%. That bubble burst. And then we took them to 0%, 10 out of the last 14 years. And now we have this massive everything bubble. Mm-hmm. And the cycle is going to repeat. And you get further and further away from reality. In other words, market forces get trounced every time you have these iterations of these big, massive debt bubbles, and then their ancillary collapses. Mm-hmm. So we have a complete artificial edifice known as the U.S. economy, and that you can add in the European economy, the Japanese economy for sure. I mean, look at over in Japan; they have a quadrillion yen in debt outstanding. They have inflation that's running at a 40-year high, over 4%, and yet they have a 10-year note yielding 0.5%. So the distortions throughout the globe are growing more intense with each iteration or each turning of the cycle.
But that yield is up, right? That yield is double what it used to be.
It doubled. Yeah, it doubled. It doubled. But Tom, if those yields were allowed to float freely in a free market function, they would be well over double digits.
Of course. Yeah. Just to make let's say all the bubbles that we're speaking about a little bit more explicit, the bond bubble, the equity bubble, and real estate prices are all, the bubbles that you're speaking about. So does the Fed have to bring all of those prices down to win the battle on inflation?
Well, of course they do. I mean, talk to anybody who's trying to afford a house. So the Federal Reserve, don't forget, was buying mortgage-backed securities in early 2022. Mm-hmm. Buying mortgage-backed securities, pushing home prices even higher. Home prices were up 20% year over year heading into the year 2022. Mm-hmm. And the Fed kept on pushing up the prices on these mortgage-backed securities, which pushing yields lower, which forced more money into the housing market. And if you look at, I don't just use hyperbole. I don't just say, oh, we've got I say a triumvirate of bubbles because I'm pulling stuff out of the air. Yes, home price to income ratios were significantly higher than the apex reached in 2005. So I'm not talking just about, nominal increases of 20% per annum back to back in the national home price market, real estate market. If you look at the Case-Shiller home price index, it clearly shows you on the nominal terms we're significantly higher than we were in 2005. But I put that in terms of incomes, and we're still higher home price to income ratios. If you look at the bond bubble at its apex, we were at $17 trillion of negative yielding debt in this world. $17 trillion. Now before 2012, I believe it was 2012, the idea that you could borrow money and get paid to do it was anathema. It was, stuff that existed only in the Twilight Zone. But after that, 2012, we had, the building up of $17 trillion that led to $17 trillion of negative yielding debt. So that's the definition of a bubble. I mean, when you get paid to borrow money, there's a bubble in the bond market. And of course, if you look at the equity market, total market cap of equities as a percentage of GDP reached 200%, 2 times the underlying economy. That has never happened before. The average of that metric is something closer to 70%, not 200%. So yes, you have a triumvirate of bubbles. And the only way you can bring down inflation is by popping those 3 bubbles. That's exactly what's happening. And when you pop those bubbles, you destroy the economy. So the Fed is scrambling between, I have to pop these bubbles to bring down inflation. But wait a second, if I pop these bubbles, banks become insolvent. So what do? You're trying to walk this very narrow tightrope. And that's why I have my investment model called the inflation-deflation and economic cycle model, because there are times when you want to invest for deflation and depression, which is where we're headed. And there are times you want to invest for rising inflation and stagflation, which is also where we're headed after this bubble bursts. Because don't you know, Tom, the solution is going to be the same thing as before. We're going to, Janet Yellen, don't you think Janet Yellen's going to say, well, let's have some kind of helicopter money program? And don't you think Jerome Powell's going to say, okay, let's start expanding our balance sheet? I mean, they've proven this over and over again. Let me ask you this. Did Jerome Powell say, I don't care? 3 banks went bankrupt, but you know what? We need to bring market forces into the supply-demand metrics. We need to let the cost of money resemble the supply of savings versus demand for money. Did he say that? No. He said, we're going to launch the BTFP, which is an unlimited amount of QE Lite to rescue these banks. And I have no doubt that when this crisis fully manifests, which will probably be later this year, he'll probably turn that loan into a forgivable loan.
Yeah.
And then we start the whole cycle of inflation. But this time, Tom, and this is important, with each cycle, which each turning or iteration, the dislocations, the asset bubbles, the misallocation of capital, the bubbles, they all get bigger. And they happen with greater intensity and with greater frequency.
And also the marginal utility of debt, of those dollars being shoved back into the economy to fix that problem, becomes less effective, right?
Yes, it just goes right into inflation, just feeds right into inflation, because you're not fooling anybody anymore. I mean, there won't be a soul alive who has any kind of objectivity to their analysis who will believe when the Federal Reserve says, I am going to bring inflation under control.
Yeah.
No, you won't, because you can't. You can't bring inflation under control unless you pop these asset bubbles. And asset bubbles don't pop gracefully. There hasn't been one example in the history of mankind where an asset bubble popped gracefully. They crash and they cause massive repercussions across the economy, especially when you deal with, maybe if you're dealing with a tulip bubble bursting, it's idiosyncratic and isolated. But when it's the bond market, the real estate market, and the equity market, you got a problem when they burst. A big economic problem.
So is that what is leading us to what you're calling the inflation-pression?
Infla-pression, yes. That's what I think. That's going to be one of these cycle turns, is going to be an infla-pression, where you finally get to the point where, the Fed's bailing out the economy and the Fed and the Treasury by monetizing helicopter money, but no one is fooled any longer. So they're not going to take this money and increase production. They're not going to go out and make anything. They're just going to buy stuff. They're just going to consume things. I mean, why would I bother creating something and opening up a factory or mine or a utility when I know that whatever I'm producing here is going to be, the money I'm going to get is going to be worthless? I'm just going to consume.
Yeah.
So you get to the point where you just have a consumption society that produces a lot less goods and services available to absorb that money supply. That's an infla-pression, where you have very high rates of inflation and no economic growth in real terms. It's all nominal.
Where all that cash is just, as soon as you get it, you're trying to spend it to be able to capitalize.
So you've broken the savings and investment dynamic.
Yeah. Instead
of saving the money and going out and building something productive, you just consume.
Yeah.
And that's as I've coined it. I actually coined this phrase back in 2012, infla-pression.
Mm-hmm. So, Michael, the last time we spoke, you told our audience about the four horsemen of the economic apocalypse being cash, U.S. sovereign debt, the dollar, and shorts. Have you made any meaningful rebalances or changes in those categories over the first quarter of this year?
Well, that's not my investment strategy. That's what I go to when we have a deflationary depression, because everybody wants cash.
Mm-hmm.
They need U.S. dollars. So you buy the dollar, you go into cash, you buy treasuries, and you short the stock market. That's sector one. That's a solid sector one in my investment spectrum that goes from deflationary depression on the first sector all the way to hyperinflation or infla-pression in sector 5. So we're really in sector 2 right now. So I have to tell you that what Powell has done with this BTFP has made me gave me pause to think that there's not going to be this. There might not be this liquidity crisis. And the liquidity crisis is necessary to get to sector 1, is when you just sell everything to get into dollars. Well, right now, the banks, what we've done is created a bunch of zombie banks now. So if you look at most of the regional banks are in big trouble. Their capital has left them, and it's left them because of a few reasons. Number one, quantitative tightening drains reserves from the banking system. Mm-hmm. And then you had this new dynamic where banks, instead of raising their deposit funds that they pay depositors, their interest rate they pay depositors, they just said, you know what, I have plenty of reserves because of the previous round of QT. So I don't really want your money, depositors, because it's a liability to a bank. Mm-hmm. So I'm just going to use my reserves, get paid interest on excess reserves with the Fed, and I'm not going to give you any money on your deposit. Well, the depositor said, okay, there's nothing I can do about that, until Treasury yields went to 5% on short-term Treasuries. So there were many people like me who went to the bank and said, hey, listen, what are you giving me on my liquid savings and checking account? Nothing. Mm-hmm. Well, I'll take all of my money out, all those deposits left, and they went into treasuries, money market mutual funds and treasuries. So now the banks are losing money through QT. They're losing money through these, going to treasuries. They're losing those deposits. And then also their assets are coming under pressure as the recession becomes manifest. So the small banks have a huge problem. We have not solved that problem. But as I was saying, because of the BTFP, these banks get into a problem. It's not like they have to dump assets in an emergency, in a lurch. What they do instead is just they take those assets, whatever they are, mortgage-backed securities or treasuries, and they go right to the Fed and say, here you are. I know they're 80 cents on the dollar or 40 cents on the dollar. No matter, commercial mortgage-backed securities are really impaired. I'm going to get 100% par value in reserves for these bonds. So we created a bunch of zombie banks. That's all we've done. So we haven't really solved the problem of slowing economic growth, but we've solved the problem of a liquidity crunch. Mm-hmm. That's my belief. And that affects how you invest. So you don't, right now, if the BTFP wasn't in place, you'd be solidly in sector 1, and you'd have to own dollars, shorting the stock market, own short-term treasuries, and be in cash. That's all you would have, because mm-hmm. everything would be going down. Even gold would be going down, but that's not the case now.
Mm-hmm. Yeah, it's interesting, Michael, that I went back and listened to our last interview, and you predicted, all of the issues that we've seen with the banking crisis here. And I'll put a link in the show notes to that episode. But you also said that gold doesn't like real rising rates. And that prompted you to sell the majority of your position in gold in the latter part of 2021. So with at least a pause, if not a cut in rates likely coming this summer, is that the time that you're going to be piling back in?
So I don't know. In the last, we don't interview each other every week. So I've been, my gold allocation now is close to 14%. I have been long gold in the miners now for the last few months, and it's been a very beneficial trade for me and my clients. So, so you see nominal rates have been falling and real rates have been falling. So, the question I have to ask is, we go back to that liquidity crisis, is are we going to enter that phase when everything gets dumped and in a search for liquidity in dollars? And I don't think that's going to be the case anymore because of this BTFP. So it might be that you should just be buying more gold and silver and platinum on the dips, precious metals on the dips now. So it's buy the dip now. And
in the metals.
I will take my position to 20%. Right now it's about 14%. I want to see a little more evidence. I have a model that I run every day. So, and because the model has high frequency components that update on a daily basis, I want to see some more erosion in economic growth, the manifestation of the economic growth. And that's going to be a brightly flashing green light to take that, the liquid portion of my gold. So I have 5% physical gold. I always recommend everybody should have 5% physical gold in their possession. And then you should have between 0 and 20% in liquid or paper gold that you could sell very quickly without any big fees or any problem. And that could be as high as 20%, and it could be shortly.
Excellent, Michael. Well, I know we have a hard stop here this morning. Everybody can find more of your work at pentoport.com, where you do a midweek reality check and a lot of excellent writing. Michael, thanks so much for your time today.
Always great to be with you, Tom. Excellent questions as usual.
Thank you, sir. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.